While April data shows inflation pressures easing, corporate statements and Fed Chair Jay Powell painting a bit of a different picture. Walmart is saying that it'll begin raising prices as early as this month as increased tariff costs do set in. Plus, Fed Chair Powell warning that inflation could be volatile going forward as we see, quote, more frequent and potentially more persistent supply shocks. So how can investors hedge against the cloudy macro backdrop? Joining us now, we've got Brian Nick, NewEdge Wealth Head of Portfolio Strategy. Brian, great to speak with you here. Look, the headline we're going for, how to inflation-proof your portfolio. What is the single best strategy for that?
Yeah, well, it's not easy at all. We can go back to the last year where inflation was really a persistent market theme. That was 2022. I think that this year looks a lot different than that. 2022, we had very fast economic growth. We had the Fed raising interest rates very quickly, and we had a lot of the inflation driven by energy. So the types of stocks, the types of sectors that did well, like energy, was really the only game in town that year, isn't necessarily going to perform well in a scenario where the inflation we're going to see is going to hit growth through pass through to consumer real incomes falling and potentially through narrower profit margins as well. It's easier for us to kind of cross things off the list that we don't think are going to work well. If we're in a stagflationary type environment, I don't want to use that word too lightly, just an environment where inflation is on the rise and growth is somewhat softer, defensives have a chance to perform well, provided that we don't see a further rise in interest rates. That's one area where you can go. There's some pricing power inherent in some of those sectors too, like utilities. And the other place you can go, investors have been going, is technology, and specifically large cap US growth stocks. And that's been one of the reasons we think the Nasdaq's been rallying, is that if you look like you're in this environment in which it's going to be a very growth constrained year, potentially with some inflation on top of that, where do we see profitability? Where do we see high quality? Where do we see a little bit less leverage on balance sheets? And that's one reason investors have been going in that direction as well.
So I'm hearing from you that large cap tech may be back as the defensive play, but I know in your notes you also talked about Chinese tech being attractive to you. Which of the two, if you had to pick one, is more attractive?
Well, we are currently overweight China in our portfolios. And again, that's despite the noise around the tariffs. We kind of ridden that through. A lot of the exposure we have is not particularly companies that are in competition directly with the US, and companies that have pretty diversified export bases. So it's not just about what the tariffs between China and the US are, although now that they've been lowered to 30%, this is less of a pressing concern. Valuations are going to, for the most part, look more attractive outside the US. We think that there are parts of the US that look quite extreme. And that's why, going back to your previous question about the 60-40 portfolio turning into 40-60, that makes sense only when you look at very, very long-term valuations. Right now, equity risk premiums in the US are very low. A lot of that is big tech kind of dragging up valuations. So if you're looking short-term, if you're looking to be somewhat insulated from the trade war, somewhat insulated from the slowdown, this may be the right sector in the US. If you're looking kind of beyond that, 5 years, 10 years, it's hard to get excited about US stocks where they're currently valued. And so we have been deploying more both in Europe and in China to try to get some diversification in terms of the valuation that we think is appropriate to invest at.
And Brian, my guest host Tim has a question for you.
Yeah, Brian, one of the things you talk about here is really avoiding some of the junkier parts of the market, whether that be high yield bonds or skeptical of the rally that we've seen in small caps thus far. What would change your mind and really to get more bullish on some of those pockets?
I think we need to see high yield spreads go wider. So I guess what I'm saying is things need to get worse before I think we'd get really excited. There was that brief moment where, right after the Liberation Day tariffs were announced, where high yield spreads really gapped out. There was a lot of things that really weren't working well during that period. That was one area that we looked at, speaking of bonds, was municipal bonds that looked attractive, again, much more highly rated, tax advantaged. Those gapped out as well because of liquidity concerns, basic kind of market functioning concerns. Those have rallied back as well. To get excited about high yield, we need to see spreads in the kind of the 500 to 600 basis point range at least. The last couple of days, we've seen them dip below 300. So we're not excited yet, except for investors that really need a lot of yield and don't have a lot of tax sensitivity in their portfolios. I think this is in sympathy with the small cap kind of underperformance that we've seen as well. These two asset classes tend to perform similar to one another in a relative sense. A lot of the small cap index is simply not profitable. So one thing we tend to focus on is, again, really emphasis on profitability, low leverage, especially if it doesn't look like we're going to get an interest rate reset here, at least in the United States. It's going to be a really tough environment for any companies that were counting on kind of that Fed cut environment, that soft landing, or even a hard landing environment where we had a chance to reset and kind of bounce back. It's going to be tough for any investors that are sensitive to valuation and are sensitive to where we are in the cycle for these asset classes to lead.
Well, speaking of interest rates, Brian, you look at the U.S., you have the Fed that's pretty much on hold. You have a favorable tilt toward Europe here. Can you talk a little bit about that? Is it anything beyond rates that gets you excited there?
Yeah, we still think the valuation is attractive in Europe. It's obviously closed a bit with Europe outperforming so much this year. We're not leaning quite as hard into the things that have absolutely been working. If you're looking at like German cyclicals, we think that story may be, again, for now, largely priced in. But there is definitely a difference in the environment here. Europe is not at war with the rest of the world in a trade sense, the way that the U.S. is. So that's an advantage for European companies. And as you alluded to, the European Central Bank has been much more aggressive. They're not alone. It's been really the other developed market central banks have been able to cut interest rates a lot more and again create that reset that's really positive for cyclical companies. That's why it's so hard to get excited about cyclicals in the US. When you look at the economic growth forecasts, I think we've probably seen the bottom in terms of the downward revisions. But if you're growing at 1.3 or even 1.5, that's below potential. And with the Fed not cutting because there's concerns about inflation, that kind of puts us in a very tough spot, again, relative to the rest of the world. So we're not saying that Europe is the long-term answer here for clients, but we do think it's worth, if you've been underweight international stocks, especially MSCI EVA developed markets, including Europe, now's the time to look at least getting back to that strategic weight.
Brian, I want to end on something you mentioned at the end of your notes here, that the U.S., a big risk is a constrained workforce. And a story I've been monitoring this week is Klarna saying that they could cut about 40% of their staff because they can AIify their staffing. To what extent do you think that is a risk for the economy, but then also a potential upside for companies as they could potentially cut costs?
Yeah, I think the AI trend is going to be generally positive for productivity growth and should actually loosen up some of the concerns that I've been concerned about in the short term, which is that we simply have a sort of historic high numbers of people and percentages of working age people actively employed. And so it's hard to know where we're going to get more workers from at this point. Part of the way that we managed to, I think, but some would say miraculously avoid recession in 22 and 23 was that we had this large expansion of the U.S. labor force. We had high productivity growth that kind of carried us through and allowed us to get rid of inflation without getting rid of growth. The concern now is that with the Fed still in sort of a restrictive tilt here, we've seen productivity growth come down. We've seen labor force size sort of cap out here. And unless there are kind of innovative technologies that are going to increase productivity growth, loosen up the available pool of workers, I think we could be in trouble here, and we could be seeing any efforts to stimulate the economy go towards more inflation and less towards growth because we simply lack the capacity on the supply side to fill all the jobs that are being promised here.